All right, guys, welcome back to FreightWaves Now. It's time for today's oval-shaped table talk, and I'm going to call it an oval because there's four of us on this one today. So we're excited to continue this conversation that we started with Grace Sharkey last week about what the venture capital market looks like in an economic downturn. So I've got Grace with us. I've got Ben Gordon with us, who is CEO and managing partner at Cambridge Capital, and Anthony for a little bit of an econ side to things. So Grace, let's kind of set the scene with you. We talked about this article last week with you, kind of what the VC market looks like. And now that the cheap money's gone, what's going on? Give us a little bit of a rundown through your article first.
Well, the point of the article is last year I kept hearing from a number of people to know why are valuations so high? Why are we seeing so much action right now? And I wanted to showcase really how the economy and how it's performing was a big piece of why we saw a lot of those big valuations, a lot of those large investments, and the incredible large case of unicorns that we've seen in such a long time. I think it was honestly this month last year where I remember emailing Dooner and just saying, like, get that unicorn mask out, because you're just I think you had two or three that he had to report on or talk about. So I wanted to showcase to maybe those that aren't as subscribed to the investment arena why exactly that was happening, why we saw so many VCs out there making strong investments. I mean, it was set up perfectly for them, and why we're starting to see some of that fall off as we begin this new year, and really focus on really the tail end of that article, that we're going to continue to see investment in this space, but I think it's going to be way more strategic. I think it's going to be focused on companies that are actually going to showing profit at this time, where in this case last year, you could have very little revenue on the board and kind of name your price. So I wanted to really showcase the two markets that we quickly saw swing, much like we see in the carrier aspect of things, right? That's the fun part about the economy, is it has its ebbs and flows, just like we see in the freight economy as well. And I think it was a perfect time to showcase just exactly what we should expect from freight tech investment this upcoming year.
And I think it was this really kind of good glimpse into just how quickly things changed. And so Ben Gordon's with us from Cambridge Capital. And Ben, sitting in the investment space, what was your kind of perspective on this? Was it almost a shock at how quickly it went from the cheap money, the let's invest in places we're seeing these huge valuations, these unicorns pop up, to kind of, as Grace mentioned, a more strategic approach to things? Was that surprising to you?
Well, I think it was surprising that it happened now and that it happened this quickly. It wasn't surprising that it happened. I think for several years, many of us who lived through prior cycles have said, hey, this can't continue. And I have the misfortune or fortune of having lived through the dot-com boom and bust of over 20 years ago when I was running a startup called Threeplex. And in 99, we thought we were geniuses. And in 2000, we thought we were idiots. And the reality is that when the markets are booming, as an entrepreneur or an investor, it can feel easy. And then when markets plunge, things get a lot harder all of a sudden. But for me, having lived through that with Threeplex, one of the things that I think I was prepared for was the expectation that at some point, this market can't continue to go up exponentially. Things have to change. And so for us, look, at Cambridge Capital, we've invested in 7 companies. We have always been pretty focused on unit economics, companies that are either profitable or have a path to profitability, and where the contribution margin and the ability to continue to improve economics over time is pretty clear. We passed on a lot of things, and we felt dumb about missing out on a lot of companies that, at least on paper, became very successful. But the reality is, I think markets tend to overcorrect on the upside than on the downside. So we'll see. Maybe this continues. Maybe it gets worse. It took 3 years for the 99 to 2003 cycle, really 2000 peak down to 2003 before things started to come back. And so maybe this will continue for a while. Maybe this will be a couple of years. But for sure, the lesson for us and for the companies that we're working with is focus on companies that have great unit economics, that are creating value for customers, that are getting paid for it, And if they're not profitable, at least they have a path to profitability within the next year or so with clear metrics that prove they're getting there. And I think the companies that do that, they're going to do great. It's worth noting that some of the most successful companies that we know today were founded around the time of that Great Recession or coming out of that Great Recession. Facebook, for example, was founded in the 03-04 timeframe at a time when in the beginning it was pretty hard to attract capital and the markets were pretty pretty unwilling to support entrepreneurship, and obviously things changed pretty quickly, and you see where they are today. And that same holds true for many other companies. So it's tough. It's probably a grueling time for most entrepreneurs. But I would say that if you get the unit economics right, now could be a fantastic time.
So Anthony, from the economic perspective on this, what are some of those key macroeconomic indicators that investors might be looking at now that's giving them a little bit of pause? Are there some metrics that are making them worried?
So I think one of the things that got mentioned, Ben really kind of brought up and highlighted, is something that he has a framework. He looks at the unit economics. He looks at, is there profitability or is there a pathway to it? And I think that's going to be one of those areas that everyone should have been on board with. Mm-hmm. So Ben has been doing the right things all along, but it's easy to kind of get out of that when times are good and when it's such a busy time, especially within the freight environment. And so when I think about venture capital, the thing that stands out to me is capital and capitalism. This isn't a charity, but it can almost seem like it during times of economic boom and growth. And you don't have to be truly innovative to really kind of receive any funding or anything like that. And so if you are truly innovative, even in an economic downturn, macroeconomic downturn, or a freight recession, because the two can exist separately at different time frames, you can find success. But when you look at these economic downturns, it doesn't necessarily mean that these freight environment and freight investments have to fall off a cliff, but it does mean that they have to truly prove their innovation there.
I like that. That's a good way to look at it. I like that. Ben, when you look at companies now that are kind of sitting in this position of, okay, maybe we raised some capital during this boom cycle, and now what are we going to do looking forward? Is there anyone that sticks out to you as either having done things right, or maybe they didn't capitalize as much as they needed to during that boom cycle, and now they're kind of lost or kind of left sitting like, okay, we got to take stock of things and kind of figure out how to get through this downturn?
Well, let me take the first half of your question. Companies that I think have done it right. I think one, there are companies that raised a lot of money in this past cycle, and they're now figuring out how to take that capital, that cash hoard, and turn it into a foundation for long-term growth that should be sufficient to get to profitability. I was in Israel last week. I got to see our portfolio company Bring on Sunday, the last mile company. Bring raised over $100 million in the last round, led by Insight, and lots of capital on hand. And the Bring folks are, I think, very wisely saying, okay, we've got this tremendous capital base. What do we do? Number one, let's make sure the company gets to cash flow positive with what's there, while continuing to grow, continuing to deliver value for customers, and continuing to be what I believe they are, which is a market leader in last mile. And then number two, let's recognize that the metrics by which the world evaluates a company like Bring has shifted. And a year ago, the primary metric was growth. The metric today, I believe, and will be for the foreseeable future, is its unit economics, its contribution margin, customer satisfaction and value creation, and ultimately it's the ability to deliver profitable growth. And so, that's one classic way to look at it. Another would be our company Green Screens, just had a board meeting earlier today, and really they are now just about at cash flow positive, while at the same time growing rapidly at which should be 5x this year. And what Don and the team over there are doing, which I'm very proud of and think that they've been very wise about, is they're saying, okay, we've got plenty of cash. We've got the ability to really help logistics companies in a meaningful way. Let's just focus on succeeding with the resources that we have, and as opposed to growth at all costs, let's continue to boost the trajectory, become a profitable company, which is happening really in the coming quarter, and then figure out how to add capabilities. And okay, so maybe you don't invest as aggressively in sales and marketing. Maybe you don't double or triple the sales and marketing team, but you don't need to if you could still grow it 5x, deliver great value for customers, and be profitable. So I think those are two examples, one at a very large level, one that's at a smaller, high growth level of companies that I think are doing it right. I don't want to take the opportunity to trash talk anybody, so I think I'll let anybody else answer the second half of people that aren't doing it right. But I'll stay positive and go with the high road.
I think that's 100% fair there. And so, Ben, I have a question for both you and Grace. Grace, I'll start off with you, and Ben, maybe you can pick up this one as well. When I think of 2018 and 2019, and I think about the freight market, I think about the big thing throughout that time frame was transparency. I know we at FreightWaves we're really pushing it, we're still pushing it, and really trying to bring that level of data to every single person, every single player in the market. But now I'm starting to see a shift from transparency, still including it, but now collaboration. Not to say that these are bad things, but these are kind of sometimes buzzwords I'm starting to hear a lot more throughout, freight circles and things like that. When I think about the current freight environment, or when you think about the current freight environment, is there a section or a portion within the supply chain that might seem to be a bit oversaturated or overplayed in terms of freight tech or certain types of seemingly innovative solutions that really maybe there's going to be stiff competition to kind of try to really get into?
So you didn't get enough of the. Oh, go for it. I was going to say, you didn't get enough of the real-time visibility term last year then, huh? No, I think if we're going to talk about companies that possibly might have issues during this time, I think the real-time visibility players, the transparency players that aren't bringing true value to their customers right now, or maybe the opposite. Let's go to the ones that are actually focused on their product, right? Focused on now taking that data and using it to actually bring value to their customers. Those are the ones I'm excited to see the most. I think what is really important is now clearly what are the type of tools that you're going to create now that you have these big pools of data in front of you. What customers are you working with that are going to continue to keep investing in R&D and during these times, right? A lot of these companies are set up with large Fortune 500 companies who I think are going to really want to see some of that value play out with the problems that they're still seeing in their supply chain today. So I think that's we went through the 2021 year of visibility, insight, real-time data, etc. Those fun buzzwords that I get to write about all the time. And now I think when we start to look at waste mitigation, cold chain visibility, things of that nature, and actually providing products behind it that are being used today, being paid for today, that customers are actually using to improve their supply chain. Those are the interesting cases I'm excited to see play out over this next year or so.
So for a different or maybe a contrarian view, I would say digital brokerage. That's a category where I think there's been overfunding, overcrowding, and you're going to see some people that will eventually shake out. I'll just give you an example. We had a discussion last year with a digital freight brokerage company that we looked at investing in. And I remember asking the question, what's your differentiation? And the founder actually said, because we have venture capital, we can afford to operate at much lower margins. So if your average freight broker is charging, 15-16% gross margins, we could do it at 3 or 4%. And I remember scratching my head and talking to my partners and saying, did I just miss something here? This seems crazy. And by the way, in their defense, if the market was willing to give somebody like that enough money, in the end, guess what? They come through that and become a much bigger, better, successful company. I'll give you an example, although they had other differentiation. In 2007, when Jeff Silver raised $100 million from Warburg Pincus, to build Coyote, one of the things that Jeff did was cut margin, but he did other things too. He also invested aggressively in technology and built out a capability that was, I think, very compelling. But in addition to that, his ability to underprice and pick up volume helped him scale up a hell of a lot faster. So it's possible if you have A, enough capital, and B, something else besides the willingness to cut price to be very successful. But if the answer to your strategy is we're going to win because we have venture capital and that allows us to operate at a lower margin or a negative margin, not a great strategy. And I won't name names, but I know a couple of digital freight brokers that either shut down or sold at a fraction of capital raised because of that. I think you're
Right.
going to see more of that because fundamentally, the great truck brokerage companies, they're already tech enabled, right? I mean, if you look at XPO, just put out an announcement yesterday, I guess in context of their quarterly earnings, and it showed the level of digital penetration with their customers. And I think something like over 70% of their transactions now have a digital component, and it's gone up every month, over the course of the last year.
Right.
Similarly, if you talk to Doug Wagner at Echo, he'll tell you that he thinks, and maybe have him on for a debate with a digital broker, that he's got better technology than any of those digital brokers. And so it's not like the digital brokers are providing technology, whereas everybody else is a Luddite that doesn't know how to use a calculator. It's actually a pretty sophisticated industry. So I think the digital brokers that are doing nothing other than cutting price because they have capital, a lot of those guys are going to fail. But other ones will succeed if they have meaningful differentiation. And so I think it'll just force a shakeout between winners and losers.
Awesome, guys. Well, thank you for participating in this roundtable, and a super incredible discussion to have all three of y'all on with us.